Okay, we're going to go through a series of problems on long-term assets and how we account for those. So this first one, we have Oak Tree Company purchased new equipment and then made the following expenditures related to that equipment. The equipment, including the sales tax, was purchased on an open account with payment due in 30 days. All other expenditures were paid in cash. So prepare the necessary journal entries to record the expenditures. So we would debit the equipment for the purchase price and the sales tax. So 45,000 plus the sales tax. And then like they say, that is on accounts payable. I'm going to abbreviate that a little bit. Then all the rest are paid in cash. So the freight is necessary to ship, to get the equipment on site and to get it up to our ability to be able to use it. So we're going to capitalize that to the equipment account as well. Then the insurance on that equipment for the first year, that we would not capitalize. That is going to go to insurance expense. If it was ever insurance while we shipped it, we would capitalize it because it's necessary to get it, to its intended use. But in this case, it is not. So it is for the first year after we start using it. So it would be expense. Okay, then the installation of the equipment, that is going to be necessary to get it ready for its intended use. So that we would capitalize to equipment and then credit the cash. So just make sure it's something that is necessary to get it to its intended use. Then we're allowed to capitalize it. And when I say capitalize, I mean it goes to the actual equipment account. If it's something that occurs after we would get it there and it's, it's going to benefit us in the future, then that's going to be expensed. Okay, then our next one, we have acquisition costs and a lump sum acquisition. So we have a manufacturing company that purchased land and a building for $4 million. In addition to the purchase price, Samtech made the following expenditures in connection with the purchase of the land and the building. So title insurance, legal fees for drawing up the contract, prorated taxes for the period after the acquisition, and then state transfer fees. An independent appraisal estimated the fair values of the land and the building, if purchased separately, to be 3.3 million and 1.1 million. So shortly after the acquisition, Samtech spent $82,000 to construct a parking lot and then $40,000 for landscaping. So determine the initial valuation of each asset Samtech acquired. Okay, so we'll start there, and I think I'll go over to this side here. So we have land and building. So we're going to end up having, I'm going to just do the total cost that they're going to end up paying. So we'd have our purchase price of $4 million. $4 million for the purchase price. Then we would include the title insurance because, again, that's necessary to purchase the land and the building, the legal fees. The prorated the property taxes for the period after acquisition are going to be expensed. If it was before, if we were assuming some past due ones as we were purchasing this, then we would include it in our price, but not on that go forward basis. And then the state transfer fees, I'm going to assume, I'm not 100% sure what state transfer fees actually are, but I'm going to assume that means like transferring the deed to their name. So then that would be part of the cost necessary to get that land. So then we will sum that up. So then that's how much value we have in it. And then that's what we're going to need to allocate. But then we come down to our fair values, and we have the land, if we purchased it separately, would be 3.3 million. And then the building, if we had purchased that separately, would be 1,100,000. So then we'll sum those, and then we'll do a percentage. So what percent, so if I take my land and I divide it by my total, what percent represents the land? So 75. And then, so the building should be 25. Because again, we got to have 100%. So then we're going to use that to allocate them off. So then we come down here and say to allocate between our land and our building. We've got the $4,025,000 that we paid, including all those extra costs, times the 75%. So $3,018,750 is going to go to land. And then we're going to take the total price we paid times the 25%, and then that's going to go to the building. And then that's what we would record. Again, then we come down to what is below those would all be land improvements. So if we paid $82,000 to construct a parking lot and $40,000 for landscaping, we're going to capitalize those as land improvements, because land improvements are depreciated and land is not depreciated. Then if there was these additional costs for number 2, if we had those demolition costs, and so if I go up here, I'm just going to adjust my total up here. So I'll just redo it here. If we had these demolition costs to get the land ready for our intended use, we would add those in here. So we've got 250,000, but we were able to sell some of the salvaged materials for 6,000. So we would subtract that out. But then there was also $86,000 in clearing. So that's going to increase our total, which then would increase how we allocate it out down at the bottom. So I think they just want you to know that we would include those costs down below and then always subtract out those salvaged materials. Then we come over to this one. We have natural resources and setting up that asset retirement obligation. So Jackpot Mining operates a copper mine in Montana, and they paid $1 million in 2024 for the mining site, and they spent an additional $600,000 to prepare the mine for extraction of that copper. After the copper is extracted, in approximately 4 years, the company is required to restore the land to its original condition, which would include repaving the roads, replacing a green belt, so again, it's all safe and looking good. The company has provided the following 3 cash flow possibilities for that restoration. To aid in the extraction, Jackpot purchased some new equipment for $120,000. After the copper is removed from the mine, the equipment will be sold. Their risk-free rate of return or interest is 10%. Okay, so if we come up here, the cost of the mine, we would have our purchase price, right, which was $1 million. In my commas to make sure I got the right decimals. Okay. And then they spent an additional $600,000 to prepare it. So those would be included. Now then when we come down, so that's going to be the cost of the mine. Is it a mine? Yeah. So then we would set that up as like a copper mine on our books, which would be a natural resource. Then we'd come down and the equipment would be set up as a fixed asset and it would be depreciated over its useful life. So that that 120,000 would not get added into the mine again, because it's a separate asset that we're going to sell later. Okay, then our ARO, or our asset retirement obligation, we have the different scenarios. So, maybe I'll go over here. So 300,000, there's a 25% probability that it's going to cost us that much. 400,000, there's a 40% probability, and then 600,000. So we really don't know how much it's going to cost us. We're just making some estimates. So then if we take that times our probability, and then do that for all three of those levels, and then we'll add those up. So then this is what our ARO, the estimated liability, is going to be. Now the thing is, it's not now. Like, we're not going to pay that now. We're going to pay that at the end. So then what we have to do is take the present value of the estimated liability. And I'm going to do my formula in Excel. You could also use your financial calculators. So if I go down to my present value, so my rate is, what did they just tell us, darn it? Let me see if I can scooch you this. 10%. Our risk-free rate of return was 10%, so that's my rate, but I got to put it in as a decimal rate. Yes. Okay. Then my number of periods is going to be the years. So what did they tell us? They told us that in approximately 4 years, the company will be required to restore the land to its original position. No payments. And then our future value is going to be the $445,000 that we potentially are going to owe. And then our number is 0 because we're doing it at the end of the period. So then that is actually going to be the present value of our estimated liability. So if we did the journal entry, we would have we'd have the copper mine for $1,600,000. We'd have equipment for $120,000. And then that's what we would pay cash for. Now the ARO, we don't pay cash for it. So why is my mind a blank as to what my offset is? So obviously we're going to have a ARO liability. I'm trying to think of what the debit is though. The liability would be that, but why my mind's a blank on that debit. Okay, hold on, let me just see if I can find it real quick. We debit the asset retirement cost. Okay, so then that would be in here. And then we credit the asset liability, and then we credit cash for what we actually pay out. Maybe double check in the textbook though, because I just kind of Googled that. Double check that that is the correct account name that they want you to use. Okay. All right, then we move on to our next one. So then here we have goodwill. So we've acquired all of the outstanding common stock of the Steinbeck Corporation for $11 million in cash. The book values and the fair values of Steinbeck's assets and liabilities are shown below. So if we have our purchase price, is $11 million. And then if we subtract out our net book value, or sorry, our net fair value, and we're going to value everything at the fair value, not the book value. So then if I add the accounts receivable, the land, the equipment, the patent, did I put in enough zeros? Let me try that again. Then I subtract out the accounts payable because I'm assuming that liability as well. Then that leaves me $10 million of the fair value of the assets. And then I'm going to subtract those though. So then the price that I pay minus the fair value of the assets gives me my goodwill. So then that would be the amount paid for goodwill. When we would record it, and if we were in an advanced accounting type class, we would really call this like an equity investment, but I don't think they want us to do that here. So we would record our accounts receivable at the fair value. We would record the land at the fair value, the equipment at the fair value, the patent at that fair value, and then we would now record the new asset that we are setting up for goodwill, and then we would have accounts payable, again, because we are assuming that liability, and then we would have our cash, or no, is that how we paid? Yes, cash. Again, if we were in a different level of a class, and we're following equity method accounting, goes to an account called equity investment, but I don't believe we're doing that at this level here. So they want us to just record those assets at fair value and then record the cash. Okay. Then moving on to what if it's a non-monetary exchange. So Bronco Corporation exchanged land for equipment. The land had a book value of $120,000. And then a fair value of, I think I'll come down below here, a fair value of $150,000. Bronco paid the owner of the equipment not 100,000, but 10,000 to complete the transaction, which had commercial substance. So what is our fair value of the equipment? So it doesn't tell us what that fair value is, right? We have a fair value of the land, and then we have a fair value, or then we gave cash. So then if we take the fair value of the land, and then we take up the cash that we gave up, and we add those two together, that would give us the fair value of the equipment, because that's what we paid. So then when we go to do the journal entry, we are going to put in equipment at the 160,000. We are going to credit the land that we are giving up at our cost, or our book value. We're going to credit our cash that we gave up at 10,000, and then we're going to credit a gain, on the transfer or the train on the, gain on the exchange. Just pay attention when you're doing the homework what your choices are for how they title that gain. And then, so again, that's going to be the difference that we need to make that entry balance. Now, if we didn't have a firm feeling of that fair value, if it was kind of unknown, then there would be no gain. Like we would just get rid of the land at its cost and give up the cash and then value the equipment accordingly. Okay, and I think that's our last one. Is that true? Oh, I wanted to do a interest capitalization one as well. So let's see. Oh no, I do have one. Okay, perfect. Okay, so then here it is. So the Marjorie Company began construction on an office building to be used as corporate headquarters. The building was completed early in 2025. Construction expenses for 2024, because again, it's crossing over years, which were incurred evenly throughout the year, totaled $6 million. Marilee had the following debt obligations, which were outstanding during all of 2024. So calculate the amount of interest capitalized in 2024 for the building using the specific interest method. Okay, so we have $1.5 million in the construction loan that is going to be at 10% interest. $2 million at 9%, and then a long-term note at 6%. So then we'll calculate out the interest that they paid on these outstanding notes and get a total. And again, they were all year, right? Yeah, so they don't give us any different time frames because sometimes there's months involved in there. But in this case, there's not. So then if we take to calculate an average rate, if we take the interest that we paid on all of those, divided it by the debt that we paid on all of that, that gives us our average rate that we're going to use. So then if we paid out the $6 million evenly throughout the year in construction costs, we're going to use that rate of interest. Oops, I need to add another zero in there, which I will go back and do. So then we would calculate the amount of interest that would be fair to capitalize to the loan. So we would use that average rate times the amount that we incurred evenly out through the year. Okay, so that is it then for those long-term assets.